Good afternoon. It's Jeffrey Christian from CPM Group. It's about a little after 2 o'clock in the afternoon on Tuesday, the 1st of February. I wanted to talk today about hedging for our investors. CPM Group issued in its short-term trade recommendations, we issued buy recommendations on gold and silver. The prices have risen. They got to our initial targets. Today, we issued new trade recommendations on gold and silver saying stay long because we do think that the prices have further to go. They still are vulnerable to the downside. And that actually is one of the reasons why we're talking today about hedging for investors, part 2. We spoke about hedging for investors last month a little bit. Staying long, how to stay long and hedge yourself, capitalize your gains, protect yourself from downside. Because if you look at gold and silver, if you look at gold, our view is that the price could get up to 1850, 1860 in the next 1 to 3 months. But we also think that it could easily spike back down to 1780. And if it breaks below 1780, you could have a bigger decline, similar to what you saw way back when in December. So, 6 weeks ago, we saw gold fall very sharply. And those investors who were long and stayed long, they didn't panic. They're okay. Those investors who panicked bought high, sold low. And one way to avoid that is to hedge with options. So we're going to talk a little bit about that today. In my hedging for investors, part 1, I told the anecdote about an investor that we were working with who was buying gold in the run up into 2008. And when the price got over $900 and shot up to 1,000, he said, should I keep buying? And we said, no, wait until the price is back around $900. We think it'll be there within 3 months. This was March of 2008. We think it'll be there, by May or June. Buy some puts. They bought some puts. Within a couple weeks, the price was back to $900. He sold those puts back and made roughly $100 an ounce profit on his hedge. Hedging is good. You try not to make money in a hedge, but sometimes you can make money in a hedge. And it's very important. And I'll talk about that as we go forward. So that's what you can do. That was an extreme example. But you can do it on a short-term basis all the time. And it's funny because we look at where we've been over the last few months. In CPM Group's trade recommendations, we've had a lot of stand-asides. Hey, the price could go up $20, the price could go down $20. There's really no clear indication. So maybe just stand aside and wait until there's clarity. And then a few weeks ago, there started to be clarity, and we said, okay, we think the price is at the bottom of this channel that's been holding for several months. It's time to buy. Right? But those past few months have been ideal for strangles or straddles, options positions. And I've mentioned that in some of our trade recommendations we have, because those are collectively written by the staff at CPM Group. And I've mentioned it in some of these things. And those were ideal. Now, looking at the market right now, the volatility over the last week or two has been high, and that's caused the hedges to be less attractive. But let's just go and take a look. I've got 2 here that actually Carlos Sanchez of CPM Group structured. Carlos is one of 2 people who has taken an option strategy that I developed and bested it and said, no, Jeff, that's a great strategy, but here's something even better. And in fact, the second option I'm going to show you, hedge option that I'm going to show you is based on Carlos's work, and he structured these. So what we did is we looked at a couple options strategies, and we're looking at October 2022 options. Now that's a long way away, but looking at the seasonality of gold prices and looking at the fact that they may well move sideways or lower between now and say September. August is too soon, July is too soon. You're probably in a better position spending the extra money for the extra time, buying options, October options, which expire in late September. You have a greater chance. And books have been written by hedge fund managers and others who always say the thing about options is your price prediction always comes true right after the options expire. And it's something that really rings true to anybody who has traded with options. So it's painful to pay the extra premium for a time, but that time is usually worth the extra premium. So what we did here is we bought a 1750 October put. It costs $58.30 outright. Now that gives you an effective floor price of $1,691.70. That is about where we've seen the gold price spike down a couple times. So between now and October, it's possible that you're going to see a price spike down to that level. But the thing about options, and one of the things that people often don't understand when they're first learning about options, you don't have to hold them to expiration. If you're a hedger, you probably will. But if you're an investor, you probably won't, because there's time decay, and that time decay gets very severe in the last 2 months of the options life. So you buy the time, you get more time, you postpone that time decay. And if the price goes down, these are 1750 options. Let's say the price goes to 1780. The price is about 1805 when we priced this morning. Price goes to 1780. That option may not be worth $58 anymore. It might be worth $83. So you buy an option for $58, you're buying insurance. You want to protect against the downside. The downside comes, you sell that option back, and you've just made, say, $25 on a $58 investment, which comes out to be something greater than a 40% return in a couple of months. So you're protecting from the downside, but you're also profiting from the downside, the way our client did back in 2008. This is one way of doing it, and $58 an ounce is a lot. And, well, you have to do 100 ounces if you're using COMEX options. There's another strategy, and this is strategy that CPM Group developed a participatory option strategy when we were part of Jay Aaron, Goldman Sachs, I guess, at the time. And we've used it ever since. And then Carlos made this permutation. Here, what we're doing is we're buying a 1650 put, which the price actually got down to, I guess, at one point in 2021. We're buying a 1650 put, but we're paying for it with a call spread between $1,900 and $2,000, right? And that generates a net premium. Well, you wind up paying $3.60, and you have a floor of $16.50, less the $3.60 that you pay, right? The improbability that it's statistically improbable that you will see the price over $2,000 between now and October. I know the perma bulls will say that that's crazy and it's going to be $10,000, but they've been saying that for 40 years. Let's not hold our breath on that one. Let's look at the statistical probability that gold prices probably won't be $2,000 in October, right? Even if it is, you're giving up $100 of the upside, but you are paying $3.60 for this protection. And again, if the price falls, you can lift that leg. You do this in components, so you can sell those puts back and make some profits on that. Why October? I told you, it's in order to buy yourself time. So with options, as I said, the one thing is you don't have to hold them till expiration. They can rise in value even if they don't go to the strike price. If they move toward the strike price, they will rise in value unless it's like almost expiration time and the time value is kicking in or has deteriorated. So if the price falls toward the strike price, you can sell them back and harvest some money, some profits. Nothing wrong with profiting. That leads to the second thing about options. You really need to monitor your positions. and you need to know what you're doing. As I said last month when I started talking about hedging and hedging with for investors, options are like dynamite. You can build bridges and skyscrapers, you can build a civilization, or you can blow yourself up. You really need to know how to handle options in order to do that. Right? So that's where we are. That's what we're doing. Again, later this month, the 22nd of February, we're planning to have our next open forum for clients where we'll get online and people can just ask us questions. If they're clients, if they want, they can send us the questions ahead of time, which allows us to be a little bit more efficient in responding and maybe even pull in some charts to help elaborate on our responses. We will be having a futures the future energy sources. We're calling it energy and metals, but it's really energy and materials because we're talking about hydrogen too. We're having that online seminar, and that will be open to the public on March 15th at 10 a.m. Eastern Time. That's it. You can become a retail investor. We do have options advisory program that CPM Group LLC runs. CPM Management LLC actually manages positions for clients. You can go to our website and learn all about what we do, the research and consulting we do, asset management, commodities management, and investment advisory service. That's all I have for now. I'll talk to you on Friday.